Welcome. In this video, when will ZBCN coin skyrocket? We will analyze it. Don't forget to subscribe, like, and please watch to the end to understand. The descending wedge pattern is one of the most valuable and important patterns to follow in technical analysis. This pattern usually represents a squeeze and reflects indecision in the market. Looking at the current price structure, there is a very clear descending wedge formation. Throughout this wedge pattern, price action has oscillated within a narrowing range over time, squeezing between resistance from above and support from below. Such squeezes are a clear indication that the market is trying to determine a direction. The descending wedge is a pattern that can offer great opportunities, especially for careful traders. Depending on the direction of the breakout, this pattern can be a harbinger of sudden and strong price movements. The descending wedge pattern can have both bullish and bearish breakouts, but in the technical literature, it is generally more likely to result in an upside breakout. This is mainly because the price compression within the pattern indicates a weakening selling pressure with falling tops and slower falling bottoms. As sellers get weaker, buyers are more likely to patiently take positions. This sets the stage for a potential upside breakout. In the current structure, the price continues to move in the inner zone of this descending wedge pattern. Both the upper falling resistance line and the lower support line represent the key zones that will determine the direction of the price. Currently, the price is quite close to the extreme zone of the wedge pattern. This suggests that a directional breakout could be very close. Because wedge patterns don't last forever, at a certain point the technical structure will break either up or down, indicating a new trend. Especially such compressed and narrowed price structures usually result in sudden and significant movements with high volume. This means that the price will either break the upper resistance line and start an upward rally, or break the lower support line to the downside and enter a new wave of correction. Therefore, it is extremely important to carefully follow the breakout direction in order to determine a trading strategy. Such structures are not only a figurative meaning on the chart, they also represent a psychological struggle in the market. Every price swing within the descending wedge is a reflection of the competition between buyers and sellers. Sellers try to push the price down, while buyers try to hold on by showing resistance. Over time, these oscillations become smaller and the squeeze reaches its peak. It is at this point that the market makes a decision. Either buyers prevail and the price breaks to the upside, or sellers dominate and the price breaks to the downside. It should be noted, however, that descending wedges statistically break to the upside more often. Therefore, an upside breakout, especially in combination with an increase in volume, increases the probability that the price will enter a strong uptrend. If the price manages to break the upper line with a strong candle, this may indicate the start of a positive momentum in the market. Such a breakout is usually supported by high trading volume, and the price movements that follow are quite sharp and directional. After the breakout, a retracement may occur for a short period of time. This retest confirms that the broken line is now working as support. After this confirmation, the price has a high potential to move quickly upwards. In descending wedge patterns, an upside breakout usually brings about a price target equal to the widest height of the pattern. In other words, the distance at the beginning of the bull determines the potential price target after the breakout. On the other hand, if the price unexpectedly breaks the lower support line, this may lead to temporary selling pressure. However, such breakouts are often the result of market manipulation, and the possibility of a fake breakout should be taken into account. But we can't decide the analysis only by the pattern. Let's look at the other metrics. Stay tuned. According to Elliott wave theory, market movements occur in a specific order, and this structure reflects both the decisions of major investors and the psychological tendencies of individual traders. This theory argues that price movements in the market are not just random fluctuations, but instead follow distinct wave patterns. The current structure forming in the price action aligns closely with this theory. A closer look at the chart reveals that the second wave in the Elliott structure has started to take shape, and it is important to examine the potential retracement levels where this wave might end. The second wave, which typically follows the completion of the first wave, is generally a corrective wave and represents a potential buying opportunity for investors. The defining characteristic of the second wave is that it marks a brief pause in the market following the sharp and strong rise of the first wave. During this corrective phase, the price usually pulls back, but this pullback does not signify a reversal of the overall trend. In other words, it doesn't mean the uptrend has ended, rather it indicates a temporary pause. From this perspective, the second wave is a healthy part of the broader upward movement. At this stage, Fibonacci retracement levels become particularly important as they offer critical clues about where the second wave might find support and conclude. The most commonly observed retracement levels are the 0,618 and 0,786 Fibonacci levels. The fact that the price is currently moving toward these zones could be an important signal for cautious and experienced investors. As seen in many historical examples, the second wave often reverses from these levels, and the subsequent third wave tends to be the strongest and longest-lasting upward wave. This positions the current level as a potential entry point for long-term positions. Of course, the exact reversal point of the second wave cannot be known in advance, but based on historical data and Fibonacci analysis, the 61.8% to 78.6% range is considered the strongest candidate zone. In technical analysis, these levels are known as the golden ratio and play a significant role in investor decision-making processes. If the price reacts upward from these levels, and this reaction is supported by strong volume, it would be a strong indication that the second wave has completed and the third wave is beginning. The third wave is the most notable part of Elliott wave theory because it is typically the most volatile, longest, and most aggressive upward movement. At this point, the most important detail that investors should closely monitor is how the price behaves at the 0,618 and 0,786 levels. If strong candlestick formations appear and volume increases at these levels, this could indicate that the second wave has concluded and the third wave is about to begin. Furthermore, many major rallies in the past have started exactly at such reversal levels. The third wave that follows the second wave in Elliott wave theory is often at least 1/618 times the size of the first wave, and in some cases, this ratio can go as high as 2:272. This demonstrates the significant potential price range that may form. In light of this information, it is crucial for investors to remain patient, avoid impulsive decisions, and carefully observe the reversal signals of the second wave. When this awaited pullback completes, those who are prepared for the third wave can potentially achieve substantial gains. Especially those investors who accurately interpret the wave structure in technical analysis can gain an edge by acting contrary to the market majority. The foresight provided by Elliott wave theory, when combined with the right strategy, can be a valuable guide toward financial success. RSI, or Relative Strength Index, is one of the most commonly used indicators by traders in technical analysis. By measuring the momentum of price movements, it helps to identify overbought or oversold zones. Thanks to this feature, it can give traders early signals about the future direction of prices. The movement of the RSI within a particular trend structure often reveals the current psychological trend of the price and the balance of buyers and sellers in the market. While RSI structures, especially in a downtrend, may indicate that the price is under pressure in the short term, a breakout of these structures can bring about a significant change in market dynamics. In the current chart, there is a clear downtrend structure visible on the RSI indicator. In such a downtrend, the RSI has encountered lower levels of resistance at each of its peaks, indicating that the price has made similarly lower highs. However, this pattern doesn't last forever. At some point, these downtrends on the RSI will be broken and replaced by an upward movement. This is because the RSI's continuous downward progression indicates that after a while, the momentum has weakened sufficiently and the possibility of a reversal is strengthening. This breakout moment is a very critical and promising stage for traders. We should wait for this trend breakout in the RSI indicator. Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.